morning. Thank you for joining us. You're smiling before I've asked you a question. Looks like you preempted the question.
No, I haven't. Anyway, good morning to you, Nikhil. And a very good morning to your viewers as well. So you basically want to ask me where we are in the market, right?
No, I was asking you that my producer told me mango prices have gone up by 50% this season.
Fine, I'll wait for your question then. I won't preempt you.
The smile what we have on our face perhaps will get challenged if markets go back to the recent lows. Do you think we'll keep on smiling or a smile will get tested?
Well, hopefully, I hope that we keep on smiling, though there'll be a lot of tests on the way. So, Nikhil, basically, we had taken a call way back in the beginning of this calendar year that the markets are going to be very trying. They're going to be choppy, and we were looking at a couple of quarters of choppiness in the market. We weren't looking at a correction as such, but we were looking at a time correction and probably some sectors doing well and some doing very badly. In fact, we had taken a very proactive call in September, October of last year that we need to reduce our exposure to mid caps and small caps. And you've seen what happened in that. There was literally blood on the street where that particular segment was concerned till last week, but things have picked up since then. Now, the whole basis of a call was what you had just before this, you had announced that Fed realized that they've gone wrong and they said that it's not transitionary, but it's sticky, the inflation. And they've been very proactively calling it out. In fact, they've been talking aggressively about fighting inflation, and that's helping in some way. Because if you see the sound bites coming out of the US today, last week I read that Amazon was ready to sublease its warehousing space. So it's obvious that they're seeing some demand pullback as such. Walmart and Target were talking about, even after the quarterly results, they talked about increasing discounts to get rid of inventory, sluggish inventory. So it's obvious, and obviously the biggest indicator was when, despite the Chinese lockdowns and the shipping lines being clogged near China, the rates between US and China went down, the freight rates between China and US went down. So it's obvious that things are, it seems, cooling off in the US. So that itself is and US being the biggest consumer in the world of commodities, obviously you see that impact. Already you've seen that in quite a few commodities. It's cooling off. The prices are cooling off. Crude, however, remains a joker in the pack. It's already from the peak of 120 odd, it's down to 114, 13, 14 today. But the fact is that it's fairly volatile. And that is mainly because of the geopolitical issue going on between Ukraine and Russia, rather the war going on between Ukraine and Russia. So that apart, you come to the domestic market. So that's one positive that we're looking at. And that's why that big smile on my face. So that's one positive that we're looking at. The second one is the market, our market itself. The valuations have really come off sharply. If you look at the next year earnings, we're already at some 16 and a half odd times or 17 odd times, which is somewhere close to the last 10-year average or mean or whatever you want to use as such. So that's positive. And that's why we feel that so at the peak, we were at 25% cash. When I came to your channel last time around, which was like a month back or so, we were at 17, 18, and today we are at 10% cash. So we very selectively deploying our cash along. And I think that's what we believe, that this is a time where you can really average out your positions. You can look at opportunities in the market, which are available at good prices, and probably increase your exposure to the market. So keep smiling.
And I'll tell you why I'm smiling, Dinshaw. And for that, I'm going to trick you slightly. Let's cut to a two frame. And Dinshaw, why don't you just move slightly? Maybe just see the TV, which I can see at the backdrop. I want to tell our viewers that, look, Dinshaw Irani is sitting at home watches ET now. So for that reason, I'm actually smiling. So thank you. Dinshaw, okay. Is your conviction in large cap IT getting challenged? Because if US slows down, all this demand optimism it just will evaporate. I know IT companies, both of us, have tracked them for years now. When the problem becomes public, then only acknowledgement comes out. As of now, it's an assumption that growth will never go back. But are we in for a commentary which would be a cautionary commentary starting this earnings season?
So, Nikhil, in fact, Infosys had a analyst meet recently, and they were going on saying that they're not seeing any slowdown in demand. But as you rightly put, I mean, they look at what their book is telling them right now. But I agree with you totally. If US goes through a slowdown, IT will be, obviously there'll be certain portions within IT. Already you're seeing in retail that they're looking at cutting off their spends. Maybe not on IT right now, but that'll happen at some point in time. So we are cautious on IT. In fact, our exposure till last year was around 20% to IT at last calendar year. And if you had seen, it was around 19-20%. Today it is at 10.5%. So we are also very cautious, in fact. And the only exposure that we have is only in the large caps where we think they can sustain. I think the bigger inflection point will not only be about the demand bit, which will only trickle out later. But one thing is very clear, Nikunj, that even if you see a slowdown happening in the US, the growth rates will be far better than what they were pre-COVID. But that's not saying too much, because that was like mid-single digits. And even if the slowdown hits, we're looking at somewhere like low double digits kind of a growth rate. In fact, that's what Infosys stated, that they are very comfortable in achieving the 13 to 15% guidance as such, which is not saying too much. In fact, people are looking at an upping of the guidance. The bigger issue also will be the real will be delta will be when the attrition rates come off, which I think it's a matter of time before, it happens as such, because looking at the slowdown and obviously in the unlisted space, if you see quite a few companies are shutting down as such, and you're seeing a lot of flow coming back to IT. So they will have some buffers, but ultimately it will be valuations which will matter. And today they are at fair valuations, they're not at cheap valuations, even after the correction as such, if the growth rates slow down, that is.
Good morning, Dinshaw. Avan as well joining in. Another reason for you to smile is Vedan Fashions, a stock which you guys have been very bullish on. And it's been doing quite well of late. There's also Campus Activewear, and the company's been talking about very ambitious plans. Take us through the rationale, because I know that there's this affordable luxury theme that you're focusing on. So let's talk about these two stocks in detail.
So, Avan, basically what we're doing here is that we've highlighted stock. So basically what you're trying to do, you're trying to appeal to a base of some 300 to 350 million consumers, which is your mid-income class, which is an aspirational class, and they want to do well in life and stuff, right? So, and that's a huge base we're talking about. Though India has 1.4 billion population, but actually the discretionary spenders are somewhere like 350 million. So this is the kind of strata that we want to appeal to. And that's why we highlighted these, not only these two names, there are quite a few others that we've got into as such, which will be appealing to this. Now, Manyavar, you mentioned the name. In fact, I remember last time Nikunj was confused about which ethnic wear company I was talking about. But the fact is that that particular, I think it's got a lovely moat in itself, because the kind of complex. So you've seen that quite a few existing players, established players, have tried to crack that segment, be it a Raymond or be the Vedant Fashion and stuff, but they have not been able to do that to a very great extent. That's mainly because the kind of complexity that is involved in manufacturing one single, probably a ethnic kurta as such, because there are different workers working on different segments. You don't have one single guy making one single kurta. So it's like 70 different workers working on one single kurta. The collar comes from somewhere else. The buttons come from somewhere else. The sleeves come from somewhere else and stuff like that. Yeah. So that's how complex the business. So I think they've got that right totally to the T. And that's why we're so comfortable here. And we're looking at a very healthy growth. Last year wasn't that great, though they did fairly well in terms of the top line and bottom line both. But the fact is that now that the season is kicking in, basically you don't not only weddings, but going out, formal dinners and stuff like that. So that's where they will gain from. The other stock that you talked about was Campus, which you took it out from. We decided not to talk about it, but the fact that you mentioned it, let me just tell you a bit more here. Basically, again, we're talking about closed shoes out here. So it's very different from the existing player who's in the field, but their category is 500 to 1,000 kind of a price band that we're looking at, slightly lower than 500 in fact. So that's the kind of price band we're looking at. And that is where the bulk of the consumption comes from, this particular category of 350 million consumers. So that's what makes us more excited. They've got their model right. It's more of a online sales kind of a model. So there's no inventory carrying costs and stuff like that. So that's excites us, and obviously the growth rate again here are going to be pretty exciting going forward. So the valuation should fall in line as and when that growth rate kicks in. That's it.
Dinshaw, I see Sameer is very active on Twitter, but you're absolutely not. Need to up your game on that front because we, of course, put out all our stuff on social media. But I'm not going to question you about that. But let's talk about Jubilant Foodworks. You know, we did have it in the limelight of late, was in terms of the numbers, and then Mr. Pratik Pota's exit, and now you have Samil Khetarpal coming in as the CEO. But you guys have recently sold out this counter. Why the uncertainty?
Well, actually, a couple of them. I mean, when Mr. Pota left, we were not clear because he was the one who really took up put the game up for Jubilant when he took that up. And once he left, we were not clear about who's gonna head the whole organization as such. So that's why that was one area where we were not too certain. Secondly, the fact was that Domino's had taken 2 hikes consecutively. I mean, 5-6% at the beginning of the year, and then again 5 or 6% in around April. While the competition was fairly low, in fact, their hikes were 2-3% and something like that. So it was obvious that they were overpricing themselves to that extent, and they were still not able to meet their margin commitments per se. So that's why made us wary. And secondly, I mean, thirdly, rather, the paucity of gig workers, I mean, that was hitting the limelight very regularly as such. So it was obvious that Domino's has its own, rather Jubilant Foodworks has its own set of delivery people, and there also they'll see some inflation, so that may eat into margins. So these were the couple of questions which we didn't want to break our brains on, and we said, okay, we already have one QSR play, let's move out of this the other one, and that's why we sold off. And obviously the valuations also were way beyond the ones which were in pre-COVID levels as such for Jubilant, so that's what drove us to sell off the stock.
Good morning. This is Nantara joining in. I think you and Sameer have been quite vociferous about the fact that you trimmed down positions and you prefer that to shorting here. But having said that, May, which was such a brutal month for the equity markets, did you folks see any opportunities? You may have trimmed down stakes, but there were also stocks available at good prices.
Yeah, sure, we did, Nantara. In fact, that's what I said, that probably a month back we were at 17-18% cash. And today we're at 10% cash. So obviously, it's because we deployed that cash selectively across some stocks which we were comfortable with. We increased our position where the stocks have corrected a bit and things like that. So, and that's why that big smile that you saw on my face, that things are working out perfectly for us right now. So that way.
I was hoping you'll tell us which stocks as well.
So I think Aman already took out a few names as such from us. One other stock that we added was the biggest jewelry retailer. I don't think you need to guess that name anyway. So I think that corrected quite a bit in the month of May. And we said, this is it. I mean, we sold it off earlier. We had sold off because of the volatility in the gold prices as such. And that's why we said that we've seen that in the past. Whenever volatility hits gold prices, this particular stock doesn't do too well, and the growth rates also go down, which was right in a way. And then the stock corrected quite a bit after our selling, and we said, okay, now this is the time to get in because we're looking at affordable luxury, and obviously gold is one of the hedges against inflation. And most of our consumer base looks at buying gold jewelry to that extent. They're very good investors in gold, I believe. So that's how the thing was. So that's one name we got into. Then we also got into one of the big exhibitors, movie exhibitors as such. So that's another name that we added here. The fact was that the pipeline looks very good for exhibition, I mean movie exhibition. And secondly, the average ticket prices have moved for a very long time. So obviously it's a matter of time before they start moving that ticket prices. They have done that in the recent past. And I think that will continue going forward too.
So I'm guessing it's a PVR, right?
Yes. Yes.
And of course, waiting for that big deal with Inox also to close. So you've told us what all you bought into. You had earlier trimmed positions in IT. You said you were trimming positions in the high PE stock. I remember you distinctly talking about paints as well. But talking about the high PE stocks, you've exited Jubilant Foodworks, but there is now a school of thought that maybe those that were very expensive earlier now seem to be more reasonable. It could be, the newly listed companies, whether it's a Nykaa or even a DMart.
No, we actually are not. So basically, what are we looking at here? I mean, our call is that you need to get into those themes which have a long-term tailwind here. And both the names that you talked about are seeing a fair bit of competition. You've seen the results of Nykaa, which came out of late. The margins literally halved as such. So it's obvious that they have a lot to do going forward. So that's one. And then DMart, again, the fact is that there are quite a few big daddies in this space who are constantly, so it's like a treadmill that they'll be on to constantly be there to up their game all the time as such to meet the competition coming from these big daddies. So that's why this kind of a disconnect we don't like, and that's why we're not in those names per se.
Dinshaw, where does this whole concept of reasonable price fit in if one looks at a Titan or even Vedant Fashions? Right now, the market seems to be obsessed with the word value. Buy dividend yield stocks, buy stocks which are below 10p, don't buy stocks which are above 30p. There seems to be a mean reversion happening. You are taking a bet on buying these stocks, Vedant Fashions, or for that matter Titan, when they exactly are not very cheap stocks, when markets are migrating to the so-called value stocks.
So, Liquid, that's always been the case, right? I mean, there'll always be stocks. I mean, there'll be value against growth and stuff like that. But our feel is that quality ultimately will pay the dividend going forward. And that's why we are in more of quality names than in, and by the way, you are also aware, you've been there for ages. I'm not trying to point out your age here, but the fact is that you've seen that these low PE stocks are there for a reason. They've been hammered down for a reason. And the reasons could be many. It could be bad fundamentals, bad industry, bad management, or whatever you will. So that's why it will not appeal to us unless there's a change happening somewhere. Otherwise, we will not be too carried away or swayed by these low values as such. And frankly, I mean, the stocks that we've highlighted thus far, though they may look at maybe looking high Ps, but the growth rates here are also very high as such. So that's why they're in those names per se, and we will remain there.
What about the other side of the spectrum? Like you said, gold is a hedge against inflation, right? How about saying real estate stocks? What I'm trying to understand from you, Dinshaw, is that are we in for this era where energy, hard assets, real estate, coal, power utilities, typical stocks which HDFC Mutual Fund likes, are they making a comeback?
Okay, so the energy space, coal and the power utility guys and all, I don't think we'll ever be in that space. Maybe, I mean, if say hell freezes over, maybe then, but otherwise, no, not really. But in the case of real estate, Nikunj, the fact is that a rising interest rate scenario is always a big question mark here. I mean, they can absorb to an extent, but if inflation remains high and interest rates start moving up also, I think that will be a big negative for that space. Though we are there. I mean, we have exposure to two stocks in the real estate space. But the fact is that we're not adding to those positions. Though they've corrected and they're looking nice, we're just maintaining the position that is there as such and not going overboard here. Because I think interest rate sensitives in this rising interest rate scenario will obviously be a big question mark going forward. So that's why we're avoiding that space.
Okay, Dinshaw, it's been a pleasure interacting with you. Mangoes or markets, whatever it is, you've got a big smile on your face, and that's what matters. So thanks so much for joining in.